FY23 conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nitin Agarwal. Thank you, and over to you, sir.
Thanks, Mike. Hi, good afternoon, everyone, and a very warm welcome to Ipca Labs Q3FY23 earnings call hosted by DAM Capital Advisors. On the call today, representing Ipca Labs management, Mr. A.K. Jain, Managing Director, and Mr. Harish Kamath, Corporate Counsel and Company Secretary. I will hand over the call to the Ipca management team to make the opening comments, and we'll open the floor for questions. Please go ahead, sir.
Good afternoon. Thanks, Nitin and DAM Capital for organizing this call. Good afternoon to all participants, and thanks for taking out time and joining us for Q3FY23 earning call. Today's earning call and discussions and answer given may include some forward-looking statement based on the current business expectations that must be viewed in conjunction with the risk the pharmaceutical industry business faces. Our actual or future financial performance may differ with what is projected and perceived. You may take your own judgment on information given during the call. Domestic formulation business has delivered 9% growth for the quarter from 645 crore to 702 crore. First 9 months of the year, the domestic business has delivered a growth of around 10%. Pain segment, both rheumatoid arthritis and osteoarthritis continue to lead the business with 15% growth for the quarter. Cardiovasculars and anti-diabetic segment growth has been lower at around 2% for the quarter. Anti-malarials continuously in last 3 quarters continued its decline. Even in this quarter, it has declined by almost around 26%. Anti-malarial domestic business, and overall for the all 3 quarters, this business is declining by almost around 37%. In spite of all that, we have continued to improve our market share in Indian pharma market. In last 5 years, in 2018, our market share was around 1.85%. 19 it became 1.61. 20 it became 1.76. 21 it became around 1.77. 22 it has become 1.86. So on continuous basis, we are improving, not only improving our market share, we are also improving our rank. We were 21st company, now we are 17th company as per the Ipca numbers. We have 5 brands in top 300 brands, and all 5 brands in current year has improved its further ranking. Zerodol SP is 17th ranked brand now with 9 rank jump over last financial year. Last calendar year. Your Zerodol P is 57th rank with 6 rank jump over last year. Hydroxychloroquine is almost around 132 rank with 14th rank jump over last year. Zerodol TH is 264th rank with 38th rank jump over last year, and Folitrax is 284th rank with 33 rank jump over last year. So all 5 top brands has jumped the rank in the current financial year overall. These numbers are based on IQVIA trade audits met December 22. We are consistently outplaced the industry growth in last 4 years with highest growth in top 30 companies. With 3 rank gain over previous year, Ipca is ranked now 13th in acute therapies and 1 rank gain over the chronic segment. Now we are ranked 18th in chronic segment. In December 22, we have outplaced the industry in both acute and chronic growth as per the IQVIA numbers. With addition of almost around 1,500 reps in the current year, we hope that we will continue to improve our penetrations in the market and further improve our market share in domestic market. Most of the product where the NLEM pricings was to announce is already announced and published now. We expect almost around 15% reduction in the control segment scheduled product pricing in the whatever we have almost around 104 SKUs on which the prices was to be announced, and everything is announced now. The price reduction is in the range of around 15%. And with almost around 12% price rise, which will happen in April, overall, probably for next financial year, the overall reduction in scheduled formulation prices would be almost around 3 to 3.5% in between. And by and large, the impact of these price reduction will happen only for the maybe around 3 to 4 months in the month of February, March. Then April is going to be the major. By the time the new prices will come from May onwards, I think overall reduction may come down to, but Q4 impact will be full. Yeah. Overall, our scheduled formulations, your contribution to the overall business has gone down significantly now, because one is antimalarials, which are mostly scheduled formulations, that has declined, and also because of this reduction in pricing and all. So overall, your scheduled formulations are now contributing only 17% of our business. So rest of our product portfolio is not covered under schedule. It's all non-scheduled formulations. So on export branded formulation market, this quarter we have delivered growth of around 17%, from 109 crore to around 125 crores. For first 9 months, the business growth has been around 11%, and I think for whole of the year, we should be growing in excess of around 17 to 18%. The fourth quarter growth will be further significant in your promotional market segment. Market like Latin America, Middle East, Africa, Southeast Asia has delivered better growth for the quarter. CIS has delivered around 11% growth for the quarter. The generic export business, including institutions, has delivered 14% growth, and excluding institutions, the growth in generic business has been around 6% for the quarter. After first 2 quarters of decline, because of various issues which were facing, industry was facing lower demand of API, price reductions, nitrosamine impurity, azido impurities, all these issues, and therefore business of active pharma ingredients has declined in first 2 quarters. API business this quarter has delivered around 4% growth to around from 310 crore to 322 crore. For the first 9 months of the current year, the business has declined by around 7%, from 1,084 crore to around 1,004 crore. For most of these declines will get covered in the fourth quarter of the current financial year. We hope that probably there may not be any decline in the API business in the current year. There may not be a growth also. It's going to be a marginal side, and all the ongoing issues like nitrosamine impurities or azido impurities and all on which the regulators were facing, all those issues are now things of past. There are no issues left of that nature now. This quarter, material cost to total income ratio has come to around 34.13% as against 32.46% in third quarter in last financial year, an increase of almost around 1.67%. Largely, the cost input cost rise was there mostly in the solvents or maybe aluminium foil, but ongoing China COVID issues and higher input got converted at lower API prices. Higher cost inputs got converted at lower API prices. That has resulted, and KSM price trends are also towards decline, and therefore whatever KSMs we are holding, because of the price reduction, this impact is there. But we don't foresee that our gross margin in time to come we will be able to go back. Gross margin is not a concern for us. It's a short-term issue. For the first 9 months of current year, our gross margin is at around material cost ratio is around 33.88%, marginally higher than 33% in last financial year. The price softening trend, we hope to improve our gross margin in coming quarter. The other expenses includes your forex loss of almost around 16 crore for the quarter as compared to a gain of around 10 crore in last financial year. Apart from above, your other expenditures has largely gone up because of higher promotional cost in the post-COVID era, and large addition of medical representative additions of almost around 1,500 is also contributing to the higher cost. With their becoming productive in next financial year, we hope that this ratio will also get corrected. Our fourth quarter growth is expected to be almost around 10 to 12% range, and we expect that much better growth will come from branded promotional market, generic formulations and API business. All three will contribute better growth. EBITDA margin for the fourth quarter may get further impacted due to the change in the schedule pricing and price reductions, which will get some impact during the fourth quarter of the year. But we are confident that in next financial year our margins will certainly improve. Having given the broad numbers and guidelines, I request now participants to ask questions.
Thank you. We will now begin the question and answer session. Participants who wish to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have the first question on the line of Kunal Dhamesha from Macquarie. Please go ahead.
Hi, thank you for taking my question, sir. The first question is on the MR addition. I think until last quarter we were at 1,200. Now we have said we will add 1,500. So are we done with that addition? Is the incremental cost already baked into quarter 3 number?
Yeah, that number is done now. Almost around 1,500 people are added. There are certain vacancies, but broadly it's done now.
And sir, if that is done, why we are not able to see the jump in the employee expenses? Because I believe the fixed salaries would be part of employee expenses, right? And the allowances will be part of other expenses.
Last financial year, our business growth in domestic was significantly higher, almost around 28-29%, and therefore our incentive payment last year was very, very high. It was much above normal incentive, because on incremental sales the people get much higher incentives, and this year the overall growth numbers are lower, and therefore incentive payments are also lower, and that is offsetting this increase in the cost. So overall it's appearing that overall manpower cost has gone up by 13%, but in fact excluding incentive it's on higher salary.
Okay, perfect. Thank you for that clarity. And secondly, if I look at on a 9-month basis, our margins have kind of compressed by around 650 basis points. That excludes any forex loss or gain from both the years. Now, can you kind of provide some kind of clarity in terms of what are the major drivers? One being the MR cost, but how much impact that is already baked into this 9 months? Similarly, let's say power and fuel cost increase. Which are the major drivers of the 650 bits, and which of them you see reversing over the next year? Thank you. That's
Number one was material cost. Practically, it's around 1%. It has gone up 0.89%. And second head has been the personal costs, which has moved by 0.72%. The major increase has come in your manufacturing other expenses, which is almost around 4%. So that is major increase. Material cost front, we are not worried now, because overall there is a softening trend, and by and large all the old KSM inventories which were having more particularly in API business are slow, and and particularly also the certain inventories which got stuck up because of nitrosamine, which was at their procurement price of KSM was much higher compared to the current prices. So practically 70-80% at higher prices. So that has also not only increased the material cost, it has also depressed the margin because KSM prices has come down. So that has happened in many, in fact, KSM price, and KSM prices are soft. So overall material cost ratios are going to be soft, and I think overall margins will improve. Personal cost is higher because the numbers has moved up in current year, and that has resulted in 0.72% kind of overall increase in personal cost. As far as manufacturing and your the other expenditures are concerned, by and large on manufacturing side, as against our growth of let's say around 9-10%, your overall increase is around 13% is the increase in manufacturing side. Largely, the power tariffs were not increasing for last 2 years during COVID time, so most of state boards have increased the power tariff. Energy costs continue to remain very high. I think overall energy cost number increase is almost around 45% for current year. So that has been very high because all the coal and your other fuel, furnace oil and all that we buy for energy, that has been at a very, very high level. Analytical cost has also moved significantly because now a lot of batches need to be tested for nitrosamine tests and so many other tests are introduced. So testing cost has significantly plus. This year also a lot of work has been done to re-establish the methods, but more particularly for all those kind of testing. And since a lot of work has come at a same time, so a lot of work also need to be given outside because everything cannot be done in-house at a single time. So even that cost has been high. Then travel cost mostly is doubled. That's another cost. Shipping cost in first 2 quarters was very, very high, but from third quarter onwards, the shipping cost has started coming down. Then it's a promotional cost. The major impact during the year has been the promotional cost. And practically that has moved up by almost around 50% in the current year. So that is a major impact. It's also addition of the people and also various activities which we wanted to do as a company on various therapy areas and all that. Those activity was not there in last 2-3 years, and a lot of those activities was done. And because of that, the promotional cost is on a higher side, and that is the major contributory factor for this. With the productivity additions and with people becoming productive, these costs will come down. Energy costs, we are not seeing much of trend in further reduction, but if petroleum product cost comes down a little bit, then probably that cost may come down. But overall, there will be reduction in the cost because of higher productivity additions and also material cost softening and all that. So with that, the margins will improve.
And would you be comfortable providing any broad range in terms of EBITDA margin improvement for next year?
I think it could be remain in the range of around 21%. Yeah.
Okay, thank you. I'll join that session.
Thank you. We have the next question on the line of Cinderella Carvalho from GM Financials. Please go ahead.
Thanks for the opportunity. Sir, in terms of the NLEM impact that you mentioned, have we taken it in this quarter already, or some of it will flow in Q4 as well?
I think most of the impact is going to come in Q4 because price announcement started late, in late December, and so December impact is, I would say that very marginal. Most prices have started getting announced in early December, and then I think it has now completed. I think we have almost 104 SKUs which are in price control. All product prices are announced. 10-12 prices are announced yesterday only. So all those price announcement, I would say that I can give the number now. We have worked the numbers. It's around 70 crore reductions on annual basis as far as NLEM portfolio's price reductions is there. And it's working out to be around 15% of the NLEM product sales. Out of which, let's say 12%, as I have already said, around 12% we will get the wholesale price increase. So overall impact will be 3.5%, not more than that. And that too, it will remain for 3 to 4 months, because we are now keeping very low inventories of products, and so hopefully we will be able to do the faster implementation. So it's only going to be, say, January, February, March, and April. These are the 4 months in which the impact would be there, and thereafter and our NLEM contribution has also come down. Now it's only 17%. Because largely anti-malarials are in big way in price control, and our anti-malarial business has gone down, and with that overall your NLEM contributions to the overall say business is only at around 17% now, as on let's say January end. So overall say 83% of our portfolio is out of price control, I would say that. And so it's those impacts are going to be marginal now.
So, sir, in Q4 we'll see some impact on the overall gross margin because of this?
Q4 will be the highest impact, because Q4 will be all 15% kind of impact on LEM products would be there.
Right, and we have not built in any volume benefits because of the price cut and the 70 crore number that we are seeing, right?
That 70 crore is for full year. I'm taking full year basis. And in Q4, the impact may be little more also, because on the trade inventories in the market also, trade will ask for credit notes, and we will have to give them credit notes. So we are in process of verifying, as and when the prices are announcing, all these fields are verifying all the stockist inventories and other things, and all those credit note business will also be there in the fourth quarter. So fourth quarter impact would be greater for industry.
Right, sir. Noted. And sir, if we look at our India domestic business, our Zero Doll franchise continues to do well. But are there any other segments or specific therapies which are kind of impacting our overall growth?
The cardiovascular business, which we want to grow faster. In fact, as far as industry numbers are concerned, looking at that, we are in fact in chronic segment we are having jump of 1 rank. But our overall growth in cardiovascular segment in current 9 months is only around 4%. It's a low number. It should be we expect it to grow much faster. So that number is lower. Anti-malarials has declined by around 37%, but all other segments like and antibacterial this year has declined by 7, because last year we had almost around 100% growth because of COVID issues and others. On that, there is a very marginal decline. Say on anti-malarial antibacterials in first 9 months we did a business of 134 crore as against 143 crore. So there are 10 crore decline. So it's not significant as far as in spite 100% growth in last financial year. In fact, that is building base for our future growth also in antibacterials. Our CNS business is growing by around 18%. Cough and cold, in spite last year's significant business, we have growth of around 10%. Derma is growing by around 18%. Neuro is growing by around 13%. Ophthalmology portfolio is around 17% kind of growth. So by and large, these newer therapies are also doing very well for us.
And so on the cardio-diabetes, even the segment is also not growing as highlighting. So what is our strategy here? What are we trying to play to gain higher share and faster growth?
As far as this segment is concerned, now we have very good recognition as marketplace with whatever work we have done in last few years on CTD range and other range, and we have added 2 more divisions in cardiovasculars in current financial year. In fact, one of the reasons for little lower growth is also because of the addition of people, because doctor-product relationships and all get disturbed and all that. So that is also one reason for lower growth at around 4%. But with addition of these 2 marketing divisions in cardiovascular, and addition of products, we will certainly have a much higher growth in time to come in cardiovascular.
Thank you. We have the next question on the line of Dheeresh Pathak from White Oak Capital. Please go ahead.
Yeah, thank you. So for the domestic business, the cardio and diabetes and the anti-malaria portfolio has not done well. So what would be the for the full year last year, FY22, what would have been the sales in the domestic business for these two therapies?
So I'll give you the number.
Yeah, Dheeraj, anti-malaria last year was 5% of my domestic business, and the cardiovascular and anti-diabetics was 17%. So both put together around 22%.
Okay.
Out of that, 17% portfolio is growing at 4%. Only that 5% portfolio of anti-malaria, they are degrowing at around 35%, 37%.
Okay. But you're saying X of this, the balance 78% of the portfolio is growing at mid-teens, right? Because you said pain and rheumatoid is growing at 14-15%, and then you listed opthal, neuro, derma, everything going at mid to high teens.
17-18%. Yeah. So other therapies are growing definitely anywhere between 12% to 20%.
So what are we doing to increase the growth? Because cardio and diabetes, the covered market would not have grown at 4%, right? Have we lost market share? What is this?
In fact, we have increased. In fact, our rank has jumped in cardiovascular side. That's what I said in opening remarks. As far that on chronic segment overall, our rank is also jumped. Ipca has now become 18th company in chronic segment. We were 19th a year earlier. So compared to market, we have done better. And compared to
the market only growing at 4% in those molecules.
It's only because of digitalizations in current year, the certain lower end products, because the product reshuffle has happened. So with that, there is all those markets get disturbed. Whenever there is a realignment in business and all that, some disturbance happens. And this is the year where we have added 2 more cardiac divisions and reshuffle the products and all that. So there is a suffering on that account here.
No, so you have anyways grown better than the market. I'm saying, why is the market in those cardio and diabetes portfolio is not growing more than 4%? Something that you've done internally, right? What has happened to the market overall?
Market overall, let's say, there are probably in chronic segment, people were keeping one is higher stocks. The people were buying because of COVID times and all, 6-month stock, 1-year stock. Many people were buying that way. So those demands has now is a normalized. So now buying is on a normal pattern. So that could be one factor. Second factor also could be that a lot of the people who were in old age and all that and taking so many medicines, they have also disappeared from the market. So that's also maybe one factor which because a lot of old people have died which were using a lot of cardiovascular drugs, significant amount of cardiovascular drugs. So post-COVID also that also may be one of the impact could be there in this market, because we have never seen this kind of growth in cardiovasculars and anti-diabetics for last 15-20 years. This market has been significantly moving up. It's only in the current year that the market itself has not done that well.
Which are the main molecules that we are present in cardio and diabetes?
We have present, let's say, on diabetes, all the main kind of molecule, like say we have sulfonylurea, we have all these newer drugs.
Metformin, the newer ones also you have, SGLT2 and DPP4?
We are not marketing as an individual single drug, but we have these newer product portfolios, and like glyclazide, we have glimepiride, we have vildagliptin, we have, yeah.
Okay, and in cardio?
On cardio side, we are on beta blockers, and we are also there on clothianidone. And now the newer molecules, whatever has come in the market, we have introduced at the same time.
Okay, and the last question, did you say the 21% EBITDA margin for FY24?
Yeah, that's what I thought, yeah.
Okay. All right, thank you.
Thank you. We have the next question on the line of Amit Kadam from Canara Robeco Mutual Fund. Please go ahead.
Hi, sir. So I have two questions. One thing in your opening commentary you mentioned that because of API prices, my gross margin had impact. So just wanted to understand that particular ex API, our gross margins would have done better, or has it done better at least sequentially?
If you exclude API business, definitely yes.
Okay. And then just wanted to understand how now the prices are for the overall API basket. How our export numbers are looking forward, especially like the regions like UK, other ROWs, and then just your early commentary on the how we need to look at the tender business going forward in FY24. That's it. Thanks.
I would already say that your ROW markets, we are doing well. I think for first 9 months we had 11% growth. This quarter we have delivered 17% growth. Fourth quarter is going to be much better. And overall, I think the branded promotional market for the whole of the year would be growing around, because fourth quarter is going to be significant. The growth may come to around 15 to 16% for the whole of the year for in the branded promotional market. And most market we are doing better now. All these issues of whatever COVID-related issues and all that are not there. As far as your institutional business is concerned, probably it's going to be in the range of 300 crore to something plus. So we expect one more product approval that could have a scope of almost around 50-60 crores additions in the business. But with that addition, I think the institutions may reduce the buying of your AL. That's what we are looking at. And so overall institutional business, I am not giving much bigger number. I think overall may remain between 325 crore to 350 crores. That's the kind of number could be there in institutional generic business.
And sir, on the API part, so has that drawdown stopped?
Yeah, Amit.
Sir, in the API business, has the drawdown in terms of like the price going down, so has that stopped?
No, prices now, there is no as such dropping has already happened, because whatever KSM their trend has gone down, that with that usual prices drops already happened there. We are not seeing now further decrease in overall in the prices, and we are also not seeing the further KSM prices further going down. So, with that only now, let's say with the demand picking up, KSM prices will also start moving in next year a little bit. And API prices will also move in line with that.
Okay, but how the market has behaved in last few months, just to understand where it's getting settled?
Most I think API players had poor businesses in first 2 quarters. We also had a decline in the API business in first 2 quarters. This quarter we have done better, around 4% growth. And fourth quarter we are looking at much better growth. Overall, I think we will have some recovery in the API business in fourth quarter. Currently we are at around 7-8% kind of decline in API business. I think that may entirely get covered in fourth quarter. That's what we are looking for. So probably there may not be a growth. We may be at last year we did almost around 1,300 crores, 1,311 crore kind of business. We may be more or less at the same number, more or less in API business. So good ground will be getting covered, and all those issues which are what regulators were looking for, azido, nitrosamine impurity, and all those products, every product that needed to be tested for all that, and revised method needs to be worked out to test every product and all that. These are all filings in various markets on that. All those works are now done. So there are no those disturbing factors, and all those excess inventories in the market because developed markets were definitely carrying higher inventories of API and higher inventories also of the generics. So those also inventories have now getting depleted and all that. So probably API business will also have a good recovery in the next financial year.
Okay. So next year, FY24, on this particular base, with any new product launches and new geographies will be, because we have an expanded capacity available. So on that, can we see that organic growth to kick in?
Expanded capacity, by and large, not know what's happening. We have, I think, lined up almost around 11 to 12 product validations at Devas. And each product validations take almost around 2 or 3 months' time. So most of the time we'll be going in filing. And I think filings will start somewhere in, I think, in early next year, beginning, filings would start. Thereafter, the inspection should happen of that plant. So, because for filing you need to have 6 months stability, and then your the dossier compilations, and then filing. Some of the regulators may come early, some regulators may come late. So hopefully next year at least a few inspections should start happening of that site, and we should start getting approvals. Post that, the business would increase. So right now, we are not in our projections. We are not adding any kind of business increase coming from Devas plant, because some of those kind of production may happen and we may sell in domestic markets and all. There you will not need any kind of approvals, because all those approvals are already in place, licenses and other things. Even GMPs are in place, so that's not an issue at all. But your developed market business will only start after the inspection of the plant.
Okay, thanks.
Thank you. We have the next question on line of Sonia Patra from Phillip Capital. Please go ahead.
Yeah, thank you. Thanks for this opportunity. Sir, if you can give us an understanding whether the high cost inventory is likely to sustain for what more period. So whether it will be depleted in the coming quarter or it will take few more quarters to deplete, so that some sense on the margin front that we will have.
I think most of the inventories are now depleted. It's only matter of, let's say, fourth quarter, I think some more will go. But except one particular KSM of anti-malarials, where I think compared to the market, I think current pricing, my overall your procurement average price may be around $30 to $40 higher, because we were the early one to do the tie-up, and since the procurements and did not happen, so prices it's more particularly for artemisinin that prices have dropped to around $140 or so. My average holding may be at around $180. So that's only the KSM where it may have some impact for the next 6-8 months, but not 6 months, I would say. But
okay.
All others have normalized. This normalized in this quarter. Yeah, next quarter.
Okay. And sir, if you can give some sense about the promotional spend during this 9-month period, or directionally how much that it would have gone up versus last year.
I think almost it's around 40-45% that has moved up compared to last year. And more or less these numbers would remain at same level in next year. So with increase in the business, the promotional cost will not go up.
Sure. Okay.
That will add to the margins now. And a lot of these people added, there also this marketing cost of promotional cost has gone up. But whereas it has not added to the productivity to that an extent. So that will also help in building the margin. Yeah.
Sir, about the revised or the new process about the statins after the impurities issues that you had filed. So any update on that? So have we started seeing some recovery?
Yeah, we are back on normal business, both valsartan as well as losartan. There are no pending issues, Surya.
All approvals are received.
Everything is in place. There is no issue.
Okay. Sir, you have provided some update about the Devas, but if it since some time we have not heard about the Nagpur site, which was expected to be a kind of KSM or intermediate site. So if you can give some sense about it.
Nagpur, let's say, I think 2 months back we have got the final clearance from the government on environment side, because they have put earlier one condition that you need to get a forest department approval, and it took almost around 1.5 years time to represent and see to it that the forest clearance is not required for this site, and which finally the Environment Ministry in Delhi has accepted the Maharashtra government's recommendation that this site doesn't need any kind of forest clearance, because there are certain parameters defined that it has to be in that much kilometers from all these wildlife and everything. So it doesn't fall in that category, but it has taken almost around a very long time, because forest is a multi-layer kind of approval. So it's the most stringent approval. So it took a long time, and finally we got. We are working on some kind of flow chemistry projects which will be put at Nagpur. But because of this delay, one particular product which we were to transfer to Nagpur, that we are putting at Aurangabad. So that plant is already ordered. So that is not going at Nagpur. It's going at Aurangabad. Probably it's only in the next financial year something would happen on that. So right now we are only at basically drawing board stage, not on not finalize any kind of capex on that part right now.
Sure. So just last one question there. So this tax rate that we have guided, so I think we are currently at a much higher level than the indicated tax rate levels for the current year. So how should we be building that for next year?
The tax rate now from 18 has moved to 25 because of our opting for that method. And now because of all these judgment of Supreme Court and also last budget revision bar for disallowance of all the promotional costs. So that is adding almost around 3 to 4% kind of additional tax. So tax rate is likely to be in the range of around 29 to 30% kind of rate.
Okay. Yeah, sure. Thank you. Wish you all the best.
Thank you. We have the next question from the line of Kunal R from Nuvama. Please go ahead.
Hi, good evening, sir. So this testing cost, of the APIs that you spoke of, is it restricted to sartans or to other products also? And is it an ongoing expense?
It is not only for sartan, most of the other APIs also, and more or less that cost is now already, I don't think going forward there would be anything of that nature.
You see, nitrosamine is one kind of thing which is to be tested for all APIs, including our anti-malarials and everything, all generics, all your formulations and all APIs, everything need to be tested. And it's in part per billion. Somewhere it's maybe around 30 part per billion, somewhere 15 part per billion. So everything has to be done, and it can come from anywhere. It may not be there in your product, but it may come from water. It may come from anywhere. It can come from any kind of excipient which is being used. So a lot of validations need to be done and see to it, and all these numbers has to be filed with regulators. It's a huge amount of work industry has done in last financial year on API, intermediates, formulations, excipients, everywhere it needs to be tested because all the new standards are set. So that was a very, very tough work which industry has done in last year. It's a big.
Exactly, sir. But sir, if it, let's say, comes from water also, that means it has to be an ongoing thing, right? Because
so testings are going to be ongoing.
But initial testing, method validation, development, that takes lot of time and lot of money. Routine, once it becomes a routine part of your process of testing, then there is not much issue.
Because when you establish, you have to, so many components you need to test. But once your final product, finally everything is okay, then only your final product testing. There are 10 components, then all 10 components need to be tested. But suppose in final product, let's say it's coming in the range or lower than that range. Then subsequently it's only one test.
Sure, sir. And so maybe some aspirational guidance.
Validation, both are very big subject here. Establishing the method of testing, is a very big subject, and then validating that.
Right, sir. And I assume all the manufacturers will be going through stringent testing.
Everybody has done that. Everybody, every formulation. That's it's a big exercise. Yeah.
Got it. And so maybe on a slightly longer term, maybe on a 2 or a 3 year kind of outlook, maybe some aspirational guidance for generic export and API you would like to share?
Like I said, as we have already talked that we are already talking that from here onwards our API business should double. Formulations we are continuously doing very well in the market. We are growing around 1.5x the market growth. And with that and domestic, because with the addition of people and all, we should continuously add to the market share. In last 4 years, we have added significant market share from 1.58 to 1.86%. So we will continue to do that. And the first time, I think, in current year, we will be crossing, I think, ROW market business of around 500 crores. And at that level, we should continue to grow around 15 to 17% on ROW market business. So overall, the growth is going in time to come is going to be good. But overall, we will give the guidelines when our overall budget for the current financial year is finalized, and maybe at around the time first quarter results and all our annual results. Around that time, we will give the guidelines for the next financial year.
Understood, sir. And just one follow-up to this. If you talk of API doubling, what would be the main driver? Maybe would it be new products, or do you believe there is a lot of headroom for existing ones?
Even in the existing products, there is a lot of headroom. So it will be both new product as well as volume growth in the existing products.
Plus capacity additions. And new
Got it, sir. Got it. So I assume demand is not a concern for you. It's just some of the other.
It is not.
Got it.
No.
Perfect, sir. Thank you and all the best.
Thank you. We have the next question from the line of Nikhil from SIMPL. Please go ahead.
Hello.
Yes, Nikhil. Yes.
Yeah. Good evening. Thanks for the opportunity. 2 questions. Sir, last quarter, and this was an industry phenomena in API, that the KSM prices were high, but the API prices has fallen. As a result, the profitability in API business had been impacted. Now, during the call, you mentioned that the API prices have fallen, but they are not falling anymore. And the KSM prices have also fallen, but not falling too much. So,
right, yeah.
If we look at the profitability of the API business, based on the correction in the KSM prices and everything, are we back to the normal profitability, or is it profitability?
No, not in the third quarter. See, what has happened actually, whatever KSM we purchased at higher prices, they got converted into API, which got sold at a lower price.
Yeah.
So that was going on for last 2 to 3 quarters. Maybe some pain will be there in the fourth quarter, but from the next financial year, first quarter onwards, everything should be back to normal.
Okay, so the net profitability on API should be back to what it was probably
the gross margin on API business will improve.
Okay, fine. And this 12% price increase on the NLEM, which we mentioned, is the WPI price increase, which the whole industry will take.
Yes.
And last question, sir, if we look at last 1.5 years for Ipca, the cost pressures were too significant. So prior to in around 21, second half of 21 and all, we were close to a 24-25% kind of a EBITDA margin. And then there was a high freight cost, and then the API cost increases and the testing increases. All of that had impacted very badly, and this quarter was a worst quarter. Do you think from here on, with the cost pressures and everything getting normalizing on freight and power cost and everything, can we come back to what we were doing at around 24-25 on a longer period, not in next 2-3 years, but is the business still able to maintain that 24-25, or do you think it would be a difficult task?
The last 2 years, there were also benefit of COVID business, correct? Because of that, margins were very, very good. But having said this, now Mr. Jain has already explained. This year, there is an unusual one is increase in the people, expenses, energy cost, as well as increase in the material cost, correct? So these two things are taking away around 5 to 6% of my margin. As we progress, our business will grow because of addition of the people. This material cost, whatever 1.5-2% negative is there, it will become positive going forward. And as the people will become productive, even the other expenses portion where we are today 4% increase is there, that will also become normalized. So going forward, definitely margin should improve.
Plus, the current year, even Devas plant, let's say all costs are debited to P&L account. There are no business. It will all costs only, because till the time we start filing and getting approval, it's your depreciations and all your people costs, testing costs, all the energy costs, everything is debited to P&L account, and there are no top line coming from that plant. So it's only validation mode. So it's a 1 year, 1.5 year, that pain is there in pharma industry everywhere.
Yeah.
So that is also getting debited to P&L. It's not only people cost, it's also the plant and capacity cost is also adding to the
overheads.
Okay, and last thing, what would be CapEx guidance for next year, 24-25? Any large CapEx, or we would just look at improving the utilization?
200 crore is our depreciation, and maybe 400 to 500 crore level will be the total capex, including routine maintenance capex.
Okay. Only new project we have is the biotech project, which is coming up in MP, where we have around 150 crore kind of investment. So that will be commissioned next year. We have almost around 5 products in pipeline now. 2 are on clinical stage now. So we are building the capacity for biotech project. Yeah.
This 500 was cumulative for 2 years?
Yeah.
No, it is each year.
Okay, annually. Okay. Thanks. Thanks, I'll come back.
Thank you. We have the next question from line of Tushar M from Motilal Oswal. Please go ahead.
So just extending this discussion on this biotech, so what sort of products are we working on which kind of...
Sorry to interrupt. Tushar, your audio is not very clear. If you'd go off the speakerphone or come closer to the mic.
Is it better?
No, it's pretty muffled.
Is it better now?
Lot of disturbance, Tushar.
I'll come back in the queue maybe.
Okay, yeah.
Thank you. We have the next question on the line of Dinesh Pathak from White Oak Capital. Please go ahead. Mr. Dinesh Pathak, can you hear us?
Hello, am I audible?
Yes, you are now. Please go ahead.
Sorry about that. Yeah. So, sir, on this forex loss and gain that we show, what is the underlying nature of the, underlying reason for this? Can you just explain, like, which currency is it linked to, and which market is this operation linked to? What is it?
And by and large, all these forward contracts, let's say we have today not much of forex liability, but we have assets in terms of bills outstanding and all that. So your realizations at lower prices and forwards readjustment is all debited to P&L account. If you look at current year, we have realized gain of realized losses around 6.68 crore. Unrealized loss booked in the account is around 35.22 crores. And overall net loss because of forex is around 41.9 crore. If you look at further backup of that 41.9 crore, there's 21 crore is only account of your 10 crore is around 10.73 crore is on account of packing credits outstanding which were repriced in the books. On foreign currency loans, your ECB is around 10.3 crore. So 21 crore is on account of loans, and 20.86 crore is on account of your balance is let's say against the import of material on outstanding payments and better realizations on bills, but on forward side there is a loss of 48 crore and 40 crore is higher realizations. Overall 21 crore on trade account and around 21 crore is broadly on loans account. That's a more breakup.
But sir, on the asset side also will be benefiting, right? Because the realization will book at the higher exchange rate in the revenue line item, right?
As I said, the realization higher is 40 crores and forward gain loss is 48.84 crores. And on import side there are around 10 crore loss. So overall it's around 21 crore is on account of your business transaction, and on 21 crore is more or less around same level is on account of outstanding loans.
Okay.
Because the realized loss is 6.68 crore. Unrealized loss booked in books is around 35.22 crore. And we don't create a reserve kind of thing that when the contract gets contract gets mature and we debit instantly to the P&L account.
Understood. So on this Artemation, did you say that you will still have loss on the for last 2-3 quarters we've been having this, right? So why is it not running? Why is it not rolling over? Because how much inventory do you carry of the KSM then for Artemation?
Artemisinin normally it's a seasonal product. So normally you don't carry the inventory, but you sign contracts. So it's a seasonal. It comes in the agri season. You need to do the contract for an entire year. So your contracts are at higher price. Not that you are carrying inventory at higher price. So those contracts you have to honor.
Acha.
It's not that you are keeping every inventory in pipeline, because when your agri output comes, around that time you need to do the contract.
So this would be
particular product, as you know, the price varies. It is an agricultural commodity. History is $140 to $800. Just imagine the fluctuation in the price of this commodity.
This year, because of tenders, there was lower procurement from the authorities, so prices has gone down. There are only 3-4 manufacturers, and your contracts has to be only with them, because they are all WHO pre-qualified again suppliers of Artemisinin. Everything comes from China. 95% of that comes from China, and only 3-4 manufacturers.
No, sir, if everybody is having the same higher cost of...
But I am the largest consumer, no? That is the issue.
What happens that, suppose your procurement price and now open market prices has gone down. So, opportunity to procure at lower level is, suppose you are selling API, market would be pricing those API sales at the current Artemisinin price. It doesn't matter as far as your antimalarial formulation business is concerned. But when you do the API business, yes, it matters, because we will do the pricing based on not my procurement price, but market price and then pricing. Whether otherwise I will not be able to sell API.
Okay. And so, apart from Artemisinin, the other KSMs you carry for like 3 months?
No, there are no other KSM.
No KSMs of that nature.
No, like you said, you're explaining that we are carrying higher price KSM and the API prices come down. That is impacting the API gross margin.
No, that is what happened till Q3 end. As we speak now, there are not many KSM left out now. See, from procurement to utilization, there is a time gap, because every stage you have to carry inventory. We are backward integrated. So right from intermediate, we manufacture API. That is why our inventory of KSM in few material is higher than average.
Plus, these all certain inventories were stuck up, which was at much higher price.
Mm-hmm.
PN was at $9, it was double the rate earlier. So my procurement of those, which because of 6-8 months, all these issues, approvals and all that, a lot of those inventories are now getting disposed of.
Okay. All right, sir. Thank you so much for clarifying.
That's the major issue.
Okay. Thank you.
Thank you. We have the next question from Sayan Mukherjee from Nomura Securities. Please go ahead.
Yeah, thanks for taking my question. Sir, on EBITDA margin, so there has been a lot of volatility in the past. I mean, before the US FDA issues happened, we were at early 20s. Of course, it went up last year and now it has come down, and you're guiding for 21 next year. What's your assessment from a, let's say, 3-5 year perspective? Where do you see as the business normalizes, the EBITDA margin you think would sort of settle at?
I think from the next year onwards, from next 3 years, I would see that not significant expansion will happen in field force size, and therefore, and businesses will improve. So overall margins from that level will further keep on rising, maybe around 1% every year or so.
Understood. Okay. Sir, you made a comment around the NLEM 100 odd SKUs which have come under price control, or the prices were revised, right? So since the revisions just happened and there's an annual income impact of 70 crore, these WPI increases would be allowed in these products within few months? I mean, this will get negated? I mean, is there a visibility on that?
1st April, yeah.
Okay, there's visibility on that. Okay.
Yeah, that's the visibility. Perfect. Yeah, it's a.
So whatever price on 31st March, whichever product, you can increase to that extent. It is simple.
Okay, there is no ambiguity. Okay, great.
No, there is no ambiguity.
Okay. And sir, on US FDA, we haven't heard much. So I'm just wondering if you have any interactions and why. The FDA is, where are we on the remediation and, any progress there, and why we have not seen much progress on
From
FDA?
our side, remediation work, everything is complete. We are just awaiting inspection, and we are in dialogue with
the Office of your GMP inspections. GMP has given in writing that we are nothing, we don't need anything further from you. So and we have recommended to the inspection team. Now inspection, when they schedule, it's another team which we are regularly taking, but they don't tell that when they will come for inspection. So they have their own priorities and subsequent. But we are suddenly in the because now there is absolutely nothing is asked by FDA as far as or they don't need anything from our side as far as the remediation part, and all those issues are things of past. It's only they need to now schedule the inspection. That's all. And
okay.
That's not done by the GMP department. That's done by the inspection department. So we are in touch with them, but we don't know when they will come. That's and they don't tell that when they will schedule. We are sending another reminders to them.
So when was the last set of queries you had from the GMP department?
I think a year back, and
okay.
Final clearance has come 6 months back.
Okay.
They don't need anything further from us here.
Okay, understood. Okay. And sir, can you also give us, you mentioned about this biotech project, some capex you are doing. So if you can give some details, what are the products, what is your overall thought process on this project?
I think it's too early. We will not like to talk of products right now. Yeah.
So these are biosimilar products? So what
biosimilar. Yeah, all biosimilars, yeah.
And you want to do it for the Indian market? You have a CDMO plan, or?
We have taken the developed markets, consultations from the regulators, and all your clinical trials and everything is going to be in line with that. So Indian market, you cannot make money because it has to be for global market.
But sir, typically the costs are very high. So if you have to run clinical trials, will that mean there would be significant increase in R&D investments over the next 3-4 years as these projects, come to clinics?
I think there are some kind of each clinical trials may cost around 15-20 crores. So we have 5 candidates in pipeline. So overall cost would be going up in time to come. In current year also our spend on biotech would be almost around 20-25 crore higher.
Mm-hmm. This is the R&D expense, 20-25 crores.
Yeah, R&D expense. Yeah.
Okay. And sorry, sir, finally, if I can ask, any update you can give on your key subsidiaries, how they're doing, and any material update there you want to share on the subsidiaries?
On subsidiary side, let's say we have one company called Onyx in UK. They are doing well in UK. Good profitable company. This year there was a significant expansion there on their side. So because of that, I think their profitability is a little come down, but they are a profitable company overall, and we expect that they should be. Current year they should be doing almost around 14 to 15 million pound kind of business with around 27% kind of overall EBITDA margins in current year. Then there is another company which we have is Tropic Wellness. It's a nutraceutical marketing kind of company where we have almost around 55% stake. That company is also doing well. And they are also profitable. As far as your Onyx business extension further in US, we have one small API manufacturing and your contract research kind of company in US, small company called Ipca. But because of these COVID issues and all, our UK team could not do much on that. We have started getting now projects there, and this year they have reduced their losses also significantly, and hopefully in time to come they should do better. Only concern we have is US market is our Bayshore, which is Trendlyne. We are awaiting that once our FDA gets clear and they get to market our products, and till such time they are right now procuring products from third parties and then selling. So that company has losses. As far as another company, associate company called Krebs at Mellor and Vizag, they have reduced their losses, and I think next year that company will come in profit. That's the current developments what we have on our product mix and all currently going on. So these are the broad number of subsidies what we have. And Ramdev is basically was for FDA approved site, and that site anyway we are merging with our operations centers. There are a lot of our APIs are now under filing from that site. So that will be another site which is a FDA approved site, and from there we will then once our formulation facility gets cleared, that also will be sourcing API from that site also.
Okay, sir. Thank you.
Thank you.
Thank you. We have the next question from the line of Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, thanks for the opportunity. Just trying to understand the margin bridge. I know you talked about it a little, but you are currently at 16%, guiding for 21%. I understand top line will improve marginally. But raw material is something you've been saying that it's not under your control, those things come from China, etc. So how do you think you'll regain to that 20-21%, which was pre-COVID levels?
Let's say overall gross margins will improve because most of the portfolios are outside the price control. It's not 83% of portfolios are price control. More or less, there will be no increase in the promotional cost next year. It will remain more or less at the same kind of increase your business with promotional cost not going up. It will also add to almost around 2% to the overall margin levels in the business. Gross margin levels itself will improve by around 1.5% on that because KSM prices are soft and this was a very unusual situation in current year. So because of that, the cost is higher. And your capacity utilization with businesses going up will also increase to the overall operating performance and margin. Once in the middle of the year, I think overall Devas, if things start on commercial side, at least some recovery of expenditure will start because currently today all costs are getting debited to P&L account and there are no revenue coming right now because of all validation exercise and filing is currently going. So that will also contribute to the margins. So all those factors and there are no more additions of people next year. So it's only going to be say wage inflation, whatever addition. So with the people's productivity increase and all that, so that will also contribute towards the better sales. So it will also add to the overall margin. So all those factors will go back to that around 21% kind of EBITDA margin.
So if I understood it correct, you are saying that 150 basis points from gross margin coming back to 65% and top line being early teens and then operating leverage cost being lower than early teens, you will see 21% margin. Is that correct understanding, sir?
Yeah. More or less, yeah.
Okay. And secondly, if I see your emerging market business, ROW generics as well as the export formulation overall, there in the last 2-3 years there were a lot of inventory stocking, etc., and that's why the growth has been little volatile not only for you but across the pharma companies. Do you think the inventories and the demand, etc., have been normalized and a company like yourself could come back to at least early teens, if not high teens, in both in the overall export formulation market?
Yeah, let's say even current year, I think my European business is growing by around 20%. It's only the UK business because of and UK business will also grow from next year because that base will not be there of that a year back of Bristol. So UK will also go very well. Other markets are also growing good. So we should be able to, and ROW market will grow faster.
And API, sir?
Higher margin. API, we say that around next year, till the time those capacities from Devas are available and approval, only thereafter the business will start moving faster. But it should have around 10% kind of growth.
Okay, and that high base of that sartan, etc., is all behind us now. So on this base, we can grow 10%?
There are no now those kind of issues on all the impurities and everything else. Whatever work was required to be done has been done.
Okay, and early teens is good to model in, or we should look at mid-teen to high teens as the overall growth for the company?
I think it should be almost around 13% kind of 12 to 13% kind of overall growth.
Right, sir. Okay, lovely. Thank you and all the best, sir.
Thank you. That was the last question. I would now like to hand it over to the management for closing comments.
Hi, there is nothing further to add unless there are questions. I think we can close this con call.
Thank you,
Thank you everyone for participating in our Q3FY23 con call. Thank you.
Thank you. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Yeah, thank you.